TheoTrade, this is Don Kaufman. It's February 14th, 2020, and you are watching the TheoTrade Weekend Update. Happy Valentines Day, everybody. However, I'm not sure that, me personally, that I'm finding any love inside of this marketplace. Nevertheless, we got another week where we're grinding once again to the upside. Let's get down to business, discuss a little bit about the markets before we jump directly into some charts, a couple of trade ideas. I've actually got quite a bit to show you here on this weekend's update. First and foremost, a brief discussion of the expected move. The SPX, well, this past week was looking for just over a $50 move, and it got every single ounce of it. Now, for those of you that tune in on a week-to-week basis, you will recall the SPX had smashed through the expected move the last 4 consecutive weeks. Now, prior to that, it was a totally efficient market. We went through 23 weeks inside of the expected move. This week, we're going to hit every ounce of that expected move effectively to the upside. Nevertheless, though, I would actually call this a week that we're going to stay inside the expected move. I'll show you here momentarily. Now, don't let that catch you off guard. I mean, we're still in a marketplace that is screaming inefficiencies in every way, shape, or form. Now, let's get down, as I said, to business here. You're looking at this market and you're hearing all of the ancillary risks. I mean, come on. Okay, I don't care where you are, who you are. The marketplace just continues to shrug off risk like it just doesn't even matter. I mean, the risks are imminent. They continue to build. And put aside for a second even the coronavirus. I mean, I'm telling you, I'm watching some of the news break over there, and it reminds me, I'll just give you a brief analogy. It reminds me of probably like a year or two ago. My wife drags me to some very far off Broadway kind of show where one of her friends was starring in it. And this show was so bad. I mean, I couldn't even smile to even tell her how bad the show was at the end of it. It was too difficult, if you will, to kind of fake that smile. It was breathtaking. It was horrible. And looking at this marketplace and hearing some of the news that's coming out, I just can't help, but to feel the exact same way. You're looking at it and you're staring at it and you're like, yeah, we're at an all-time high. Allow me to give you an example for just a second. If you haven't looked at the Eurozone, I know we're here in the US, we're trading US markets. Granted, look at the Eurozone. Germany is completely stalled out. You know, we're what, like a tick away from just screaming it's in a recession, but for the most part, it's headed towards a recession. And again, all of that data in the Eurozone was recorded before this coronavirus ever really kind of, caught fire. So push aside the coronavirus for a second. The German markets are at all-time highs, and the data that came out of there is just hideous today. We also had data in the last 24 hours from the Fed that said, hey, they're going to taper a little bit of the repo. So if you're along the central bank lines, well, maybe the central banks aren't going to be there nearly as much as you thought. The yield curve just inverted again, specifically today. All right. Again, all of Europe growth, it's hideous out there. Everywhere you look, and you're staring at the VIX and you're looking at the vol futures and you're looking at the VVIX, and I don't get it. Okay. Breathtaking. I mean, it really is. It's just some hideous risks are effectively hitting this marketplace. We're shrugging them off. Okay, I'm actually going to give you a couple of trade opportunities specifically for that type of a marketplace. We will explore a little bit of some of the risk involving the coronavirus. With that, let's get down to it. Charts, a couple of trade ideas. Now, before we jump into the charts and trades, allow me to invite you TheoTrade 2020 live event. This year's theme, the Decade of the Trader. We've already sold out the VIP. The first tier is completely sold out. We still have early bird tickets right here, right now. Get your ticket, TheoTrade.com. Again, it's TheoTrade.com/live. Now, this is going to be right here in Scottsdale, Arizona. After you actually visit us, you're probably never going to want to leave. It is May 28th through the 30th It's $997. Click add to cart. Again, TheoTrade.com live. This is really all of the TheoTrade instructions are going to be there from Brandon Chapman to myself. For example, I'm going to be doing a topic, Decade of the Traders, Asset Bubbles, Non-Existent Interest Rates, Algorithmic Trading. We're going to be talking about, again, the skills that you are going to need to survive effectively in the next decade of trade. We're going to talk about good trades gone bad, battle of the bands, price action intensive, inside the NQ with Tony Rago. We're going to get into mindset, mentality of trade. We're going to have Slim Miller out here. I could go on all day about all the topics and details that are going to be covered here live in Scottsdale. Again, May 28th through the 30th here, 2020. Book your ticket right now, theotrade.com/live. To the charts and trades we go. We're going to start here on the SPX. A quick glance at expected move. Just about 7 minutes left inside today's trading session. And the markets right now, are literally, people, spot on the edge of the expected move. Allow me to really dig into this a little bit deeper. The line that you're looking at on the screen, okay, that's the same line that you're seeing right here. That's the upper edge of the expected move, better known as 33.78. For those of you that watch the videos on a night-to-night basis, on the Wednesday night video, I specifically mentioned that level and that we were looking for a pullback, okay, right into that 33.78 level, that there was an extraordinarily high probability of closing inside the expected move this week. Now, even with the next, 7-8 minutes left, if the marketplace took off to the upside a little bit, we're calling this one, people. This one is inside the expected move. Anything outside of it would be nothing more than a rounding error at this point in time. But again, week in and week out, we are just edging right to these expected moves. Again, last week we had a 50.41 expected move. Let's go take a look at it for this next week of trade. Now, okay, you need to understand that, the trading session isn't necessarily over, so some of this risk hasn't been completely settled out. You can see, it was in the 42-ish, but we're not actually settled out yet. Now we're actually down to about a $40 expected move. Why so low? Like how after, we crashed through the expected move here and we crashed through it here and we crashed through it here and we smashed through it to the upside. Now we move $50. And how do they go about contracting the expected move after seeing 4 breaches in a row and then a tag of the expected move? Well, we have a 4-day trading week. Okay, so we have a 4-day trading week. Monday, President's Day, the marketplace is effectively closed. We're going to have a Tuesday expiration, a Wednesday expiration, a Friday morning expiration, and a Friday afternoon expiration. Look at this. The expected move now is all the way down to about $40. And again, I like to record these videos when the markets are still open, give us some fresh data to work with. As I was saying a moment ago in the video portion, you've seen the risk. It just hit the fan, okay, in recent weeks. And the market just kind of shrugs it off. And, rather than recap all things I just detailed a moment ago, hey, let's actually look in detail here. All right, the VIX. Okay, so the VIX is still maintaining, all right, right around that 14 kind of handle, dropping into the 13 handle right now. Now, I'm not exactly a big proponent of the VIX. Really, I just don't get into the VIX that much because I think it's kind of my predecessor's volatility indicator. And when you look at the VIX, vola's starting to subside to a degree, but it's not really coming off all that much. Obviously, okay, because of the coronavirus, it's going to keep it perpetuated a little bit higher. But the one point that I want to make, and I've been looking at markets for a long time, if you look back over the last 3 years, there's all kinds of times where we're hitting all-time highs, right? You can point to, huge peak that hit in early 2000 and early 2018. We did it again, in September. Look how many times we're hitting highs, new highs, and all-time highs. What's interesting about this, though, is that the VIX is still substantially higher, okay, than it has been at any other point in time. There's also one big takeaway over here, and that is after we saw what is often termed right there, that's what they call the VIX explosion. After the VIX explosion, I want you to have a good takeaway from this discussion about the VIX. After the VIX explosion, okay, the basement or the bottom floor, it looks like for the VIX is probably somewhere closer to 12. Prior to that, there was no real basement. No, the VIX could get all the way down to the 9 handle. Okay, it looks like 12 is probably somewhere in that mid 11, 12 range is probably where the floor happens to be. But the point being is we're at an all-time high right now, and we are just well above that. And that's kind of the key takeaway. I have tendency to look things like volatility futures. The volatility futures, I mean, come on. You go out a little bit in time on those vol futures. For example, these 33-day volatility futures, we'll just cruise to those really quick. This is still sitting at 1540. So what that means is the here and now, like you might look at the VIX, but the VIX is nothing more than an equation of 30-day volatility in the SPX, okay? But when you start trading actual volatility, okay, the vol futures, they're up at the 1540 level. Okay, and then you start looking at things like the VVIX, the volatility of the volatility index. Okay, that thing is almost at 100, which I have to tell you. And again, I wanted to throw up like a 3-year chart in this particular circumstance. And why am I throwing in here a 3-year chart? Well, just to display. Okay, you be the judge. Markets are at an all-time high right here, right now. They're butting up against an all-time high in the S&Ps. Okay, but the volatility of the volatility index is actually much towards the upper end of its range, whereas in most of the periods of time when we were at an all-time high was actually down here at like the 85 region. I just wanted to point that out. So yeah, we're looking at the idea, if you will, that the marketplace, it's just ignoring all risk, okay? But is it really? Well, no, they're keeping volatility bid up just a bit in there, even though the S&Ps continue to shrug it off. So evidently, somebody somewhere believes that there's going to be risk because they're still technically buying up some volatility, right? And I say, does risk even matter anymore? And the reason I question that is by looking here at the VVIX, by looking at the VIX, by looking at the volatility futures, evidently the answer is, yeah, it still matters. Okay, they're still bidding them up. Now, some of the risks that we're facing here, as I was saying a moment ago, the taper, the repo market. A lot of people don't even understand the repo market. But for those of you that are like, they're Fed conspiracy theorists, the Fed is feeding us. Okay, well, the Fed just decided to cut back on the repo market a little bit, only by about 20 billion. But it's a taper. And it's much larger taper than we would have anticipated. So again, if you're a big conspiracy theorist, the Fed's doing it to us, then the marketplace should be having a little bit of a taper tantrum. Is it? No, we're massively unchanged here on a Friday afternoon. And that discussion of taper just happened last night. Yield curve. The yield curve is flipping again. So let's actually bring up the yield curve a little bit because this is one of those risks that's absolutely imminent. If you look at the TNX, this is the 10-year. Okay, effectively it's taking us to 1.5%. Now, I'm going to bring up a site. I will do this from time to time. Okay, it's the if you've never seen this site, it's the U.S. Department of Treasury. Couldn't be a more exciting site. Just kidding on that front. It's just kind of a way to look at the yield curve. And what I'm talking about here, and just so we're all clear, this happens to be yesterday. They won't update this till right after the cash close today. Yesterday, the 3-month is trading right there at about 1.59. And then we look at something like the 10-year, which is trading yesterday at 1.6. Those today, they flipped back over. Okay. What do you mean they flipped over? Here's the 10-year. The 10-year actually dropped, okay, to 1.58. So the 10-year went to 1.58. Again, I'll reiterate that. It went to 1.58. Oh, they flipped. Okay, the 3-month is now slightly above the 10-year. Now, the 2-year is still well below the 10-year, but that would be, risk is absolutely imminent. I just wanted to throw that together for you because, again, I'm just mounting some of the risks. So the taper of the repo market, yield curve is flipped, EU growth totally stalled out. You know what? Here's one other aspect that I didn't mention a moment ago. The euro is just plunging. And I'm bringing up like a 3-year chart to show you, okay, how substantial some of these moves happen to effectively be. That, people, is wild. It's one of the largest moves we've seen in recent history in the euro to the downside. In fact, when you start to pull this up, this risk over here, it's huge. And again, this is a point in time when I'm actually pointing. This is a point in time where we thought, once again, recession going to be imminent. Now they're pricing it in. Again, the euro is getting hammered, okay, in most recent trade over here. Just figured I'd bring it up. That's not something I often do. Now, I was also talking about the German economy. All right, stagnates as the Eurozone growth hits a 7-year low. If you're unfamiliar, the growth out there, it's 0.1%. That's not really growth. That's kind of lack thereof. When I was talking about the German markets, though, a moment ago, I just wanted to display this. All right, if you could bring this up, like even the maximum chart available today, literally today, the German markets, the DAX hit an all-time high. Does it matter? Well, what does what matter? Does it matter to the fact that there is no growth over there? They've totally stagnated. Doesn't seem to matter. There's complete and utter detachment, if you will, of the markets. Now, this is going to be up for debate, but I believe in the next decade they're going to be talking about and pointing fingers towards. First of all, they're going to be pointing fingers towards the Fed, the central bankers, quantitative easing. But when it comes to traders, they're going to point the fingers towards the quants. Because you have markets right now that, as I said, they are completely detached from any real economy. Because if there is a real economy out there, it surely is not in Germany right now. Now, let's bring up some of the other risks. Because here's risks that, again, we're going to start to bring up individual stocks. A lot of these other risks, they're a little harder to quantify. I don't know the effect of the repo market, and they're tapering it. I just think it's some negative sentiment. The yield curve flipped. Yeah, again, it flipped. Okay, again, more negative sentiment that usually indicates a recession. EU growth stalling out. That's just not good altogether. All right, we looked at the volatility. Somebody's buying volatility out there. And then all of a sudden we have coronavirus risk. So when you start to look at coronavirus risk, okay, where do we go from here? You know what? I want to go too deep. I'm going to actually talk about stocks. Here's the one thing, there's not too many mathematical certainties out there, but here's one of them. Okay. Coronavirus is going to get substantially worse before it gets better. The only question, I think, at this point in time is how bad is it going to be and what is going to be, okay, the broader effect. I mean, mathematically speaking, again, it's going to get worse before it gets better. China's virtually shut down. The casino stocks. I wanted to bring up, again, let's put this into context right now. It doesn't help just to show the DAX, right? Bring up casino stocks, and I'm actually going to start with Las Vegas Sands. And the reason I'm starting with Las Vegas Sands, right, is for the most part, look at the company profile on this thing. And when I say company profile, it's all about Macau. It's all about Singapore. Okay, Macau is the concern. It's basically you're looking at almost 50% of the revenue from LVS. And although this has taken some degree of a hit, you have to recognize when you start to open up a much broader chart, it's not sitting at an all-time high, but in a broader sense, okay, the stock is not far off effectively its all-time high, and it's facing some of the most serious, some of the most imminent risks, okay, that they've ever faced before. Just throwing that out there, okay? Do what you will with Las Vegas Sands. MGM, not too far off of that, okay? Now, again, we're not mentioning anything about Las Vegas, nothing of the kind, right? You bring up like MGM, bring up like a 3-year, bring up a 5-year, bring up whatever you want. Again, MGM is not nearly, okay, as reliant upon Macau. Nevertheless, if you're unfamiliar, they shut down most of the gaming in Macau. That is coming back online periodically. But as I said, corona risks it's a virtual unknown at this point. These underlyings look like they've been relatively unscathed. Now, I actually want to bring up the cruise lines for a second because there's been a lot of conversations about them. If you take a look at something like Carnival, okay, I was making a point a little earlier today. I don't know about you, but I'm not stepping foot on a cruise ship. I might be a little bit of a germaphobe. Nevertheless, I'm not stepping on a cruise ship anytime in this life. So with Carnival, yes, these stocks have actually been hit. In fact, okay, you can see that it's been a fairly rapid slide. Nevertheless, okay, from our perspective, you're looking at this, and these guys are actually facing insurmountable amount of risk. And when you start to look at Carnival, let's actually open that up over like a 10-year. Obviously, again, it's taken a beating, but that didn't just start right now. That's been going on for quite some time. But take a look, okay, more importantly, at Royal Caribbean. This one has not taken the beating that Carnival has in recent times. Yes, okay, it is slipping hard to the downside. On any bounce in here, we might look for a longer duration short position. Again, as I said, there's only one mathematical reality to the coronavirus, and that is it's not going away anytime soon, and it's still going to get worse before it gets better. How are the cruise ships going to respond? Okay, what can they respond with? For the most part, okay, probably not hopping on a cruise ship anytime soon. For the most part, too many places in the world. I mean, companies, though, foreign and domestic now, are reporting corona impacts. GM had news today. They are going to have a couple of possible part shortages. RLs for Ralph Lauren. And I just wanted to throw this up here. Obviously, a clothing store. Okay, almost negligible impact over here. The reason I'm bringing up Ralph Lauren is it just goes with the topic here. The risks are just being totally ignored. Ralph Lauren actually said they're probably going to take right up front $70 million hit. $70 million, not that much, okay? But that's what their initial hit is going to be because of the coronavirus. So we're starting to put, if you will, into context, and that's what many companies are going to be doing this next week, okay? And we're going to see at that point in time, is the market going to be able to shrug it off? Meaning that when they start putting numbers on this thing, it's kind of like Boeing. When Boeing started going through the 737 MAX kind of debacle, the smartest thing Boeing ever did, they started putting numbers to it. They started saying, all right, this is going to cost us X amount, okay? Then they took out a $12 billion loan, and they've been able to actually float themselves effectively on that. All right, one of the smarter things some of these firms can do is actually come out and put a physical number on it, and that's what Ralph Lauren did earlier in the trading day. And again, this thing, all right, really unscathed. We're hop, skip, and jump from all-time high after they just announced a $70 million loss because of the coronavirus. Now, listen, bottom line, you see the risks, all right? Now just build the trades. What are some of the trades? Okay, if you like the idea, that there are what I would term insurmountable risks hitting this marketplace, and that sooner or later some of the risk is going to start to hit, you got to start to look for risk twist spreads, infinity spreads, or get your hedges on. Listen, I know that some of you guys have 401ks. I'm going to work from the bottom up over here. Some of you guys have 401ks. When I say get your hedges on, people, get your hedges on, what I'm talking about is, right, if you have a 401k, you can reduce risk. You can put a floor into that risk. How do you do it? Okay, we're going to go out there and you're going to do things like what? Okay, you could turn around and you could buy a put, finance that put by selling a couple call spreads against it, right? That's actually what we call atomic hedge. You could actually use some futures contracts. All I'm saying is that in some way, shape, or form, and again, I want to reiterate this, in some way, shape, or form, when I tell you to get your hedges on, all I'm saying is, look, you see, okay, what the risks happen to be. It doesn't matter whether you think that those risks are going to come to fruition or not. Even if you put, okay, a 15% probability of, the marketplace really getting hit hard because of some of these risks, isn't it worth it to actually reduce your risk and reduce the portfolio risk? And I'll give you a quick example here. If I was to buy like the 331 puts, okay, if I bought the 331 puts, maybe sell like 1-2 of these, okay, go out a couple of steps out of the money, buy 1-2 of these. This happens to be what we actually call, and it's doing for a very mild debit, this is actually what we call the atomic hedge. Now, just to point this out, all right, I'm going to come over here and I'm going to analyze the trade. I'm actually going to analyze that trade. And as I analyze the trade, I want to remind you, this is a trade, okay, that would be done against a long stock or an ETF position. So we're going to come over here and analyze this trade. The way that the trade effectively breaks down is the following. Come over here and I'm actually going to day step it. All right. All I'm doing is saying, listen, if you're long the market right now, what does long the market mean? It means you own stock. You have a 401k. You have an IRA. Okay. This is an atomic hedge. And what the atomic hedge is designed to do is to put a floor, okay, into your portfolio. Now, maybe you don't have 100 shares of spiders. Maybe you don't have 100 shares of spiders. But if you have a basket of stocks, as I said, if you have a 401k, this is what I want you guys to take away from this. If you have that 401k, okay, what is a 401k? It's probably heavily weighted into the S&P 500. So I'm creating the hedge in the S&P 500. And maybe you have the equivalency of more than 100 shares. We can show you, okay, how to walk through and to hedge that portfolio. Here's 1,000 shares. So what do? You just amplify the contract size, okay? I don't want to make this too complicated. I just want you to understand, okay, that yes, you can reduce the risk of that 401k, of that IRA, of that long portfolio by risk reduction methods. That's why I wanted to cover the hedge first. Next, you look at trades like risk twist spreads. You look at trades like infinity spreads. If you don't know what they are, okay, I'm telling you, get these types of trades on. The risk twist spread or the infinity spread, that's a spread designed, if we explode to the upside, have a blow off top, or if we just tank, okay, you're going to be fine. That's what these particular spreads are designed for. I'll give you one that I literally placed today, and I'll just take you through a little bit of it. I actually placed just the RTS side of it in the XHB. This happens to be none other than the home builders. So what do the home builders look like? If you haven't looked at the XHB, the home builders, this thing has just exploded to the upside. Now, I think that if the marketplace is going to have some risk, and the risk is imminent out there, you could probably make an argument. You could make an argument that technology like Apple, they could probably stave off some of the risk, right? Microsoft, they come out with the latest, greatest, it's Windows 11, and they could probably, keep the risk off their back. But you're not going to convince me, okay, that XHB is going to be able to wipe away that risk. These are the home builders. So what did I do with the risk twist spread? I took a wild and woolly shot to the downside. By doing that, in effect, I created a fairly monstrous ratio spread, okay, and that ratio spread is out here. It's a 48, okay, 46, 45 risk twist spread. If we take a shot to the downside, so long as the XHB can get under about the 45 level, okay, between now, okay, and really like late May, this trade's going to be an absolute home run. Those are the kind of trades, people, that you really want to understand, right? When it seems like markets are ignoring imminent risks. And that's really the theme of this weekend's update here, okay? Get your hedges on, understand the risk twist spreads. This is not a time, okay, to go out there and to, you can ride this pony a little bit more to the upside, but it's a time to start to curb risks. It's time to realize that the marketplace might very well be blind to the fact that, risk is absolutely imminent. Once again, happy Valentine's Day, everybody. Have a wonderful weekend. Bye-bye.